Hello, my friends. Today, we need to have a serious, unfiltered talk about your money, your security, and the roof over your head. I want you to take a deep breath, sit down, and listen to me very carefully, because what is happening right now behind the closed doors of the Federal Reserve is going to dictate exactly how much financial freedom you have for the rest of your life. The Federal Reserve has held the benchmark interest rate steady in the range of 3.5% to 3.75%. Now, to the average person on the street, that just sounds like a bunch of boring financial jargon. They look at those numbers and think, oh, well, the Fed is on pause, things are stabilizing, I can just coast. No! You cannot afford to just coast. Complacency is the absolute greatest threat to your financial security right now. This pause by the Fed is not a green light to put your head in the sand. It is a blinking yellow light, and if you do not understand what this holding pattern means for your retirement nest egg, you are going to wake up one day and realize your money is leaking out of your accounts faster than you can stop it. I know what you are feeling. I know the fear that keeps you up at 3 o'clock in the morning. You look at the news, you see energy prices surging, global tensions rising, and inflation refusing to drop down to that magic 2% target the Fed wants. You feel this overwhelming anxiety that the cost of living is rising, while your fixed income is staying exactly the same. You ask yourself the ultimate question, am I going to outlive my money? If the Fed keeps rates right here, or if they decide to cut them later, or heaven forbid, raise them again, what does that actually do to my monthly budget, my CDs, my bonds, and my peace of mind? Let's break down the reality of where your money is sitting right now, because the decisions you make this year will determine your financial destiny. For the past few years, if you had cash, you were feeling pretty good, weren't you? As the Fed aggressively hiked rates up to over 5% to fight inflation, and then gradually eased them down to where they are now, you were able to lock in some truly beautiful yields. High-yield savings accounts, certificates of deposit, and short-term Treasury bills were finally paying you real money. For the first time in over a decade, savers were actually being rewarded instead of punished. You felt safe. You felt secure knowing your money was earning 4% or 5% with absolutely zero risk to your principal. But here is the danger. Here is the trap that so many of you are falling into right this second. A lot of you have massive amounts of your retirement savings sitting in short-term CDs or money market funds that are about to mature. And you are thinking to yourself, I'll just roll it over into another short-term account when the time comes. Listen to me, no, you cannot just blindly roll it over and expect the same result. The market is already shifting. The consensus out there is that the Fed's next major long-term move, even if it takes until the end of this year or into next year, is eventually going to trend toward easing when the economy softens. If you keep your money trapped in ultra-short-term vehicles, you are exposed to what we call reinvestment risk. That means when your 6-month or 1-year CD matures, the rates available to you might be significantly lower than what you have today. If your $100,000 CD drops from earning 5% down to 3%, that is $2,000 a year stripped right out of your pocket. For a retiree on a fixed income, $2,000 is not chump change. That is your grocery money. That is your utility bill. That is your medication. To fight inflation, you need growth, which means a portion of your retirement savings, money you do not need to touch for the next 5 to 10 years, must remain invested in high-quality, dividend-paying stocks. Look for companies that have a proven track record of increasing their dividends year after year, companies that provide essential services that people must pay for regardless of whether interest rates are high or low. Think consumer staples, utilities, and healthcare. These dividends provide you with a growing stream of income that can help you keep pace with the rising cost of living, while the underlying stock gives you long-term protection against inflation. Let's address the heavy burden that so many of you are carrying, debt. If you are entering retirement or are already retired and you are carrying variable interest debt, credit cards, home equity lines of credit, or adjustable rate mortgages, you need to stop what you are doing and pay attention. With the Fed keeping the benchmark rate at 3.5% to 3.75%, prime rates for consumer borrowing are remaining stubbornly high. Your credit card interest rates are likely sitting at 20%, 22%, or even 25%. That is not just high, that is a financial emergency. Paying 25% interest on a credit card balance while your savings are earning 4% is financial suicide. It wipes out every single good decision you are making elsewhere. Your absolute, non-negotiable takeaway is this: you must aggressively pay off every single penny of variable, high-interest debt immediately. Use some of your cash reserves if you have to. I don't care if it reduces your savings cushion temporarily. Getting rid of a 20% interest drain on your monthly budget is the highest guaranteed return on your money you will ever find. If you have a home equity line of credit with a variable rate, talk to your lender right away to see if you can convert that balance into a fixed-rate loan. Lock it in so your monthly payment stops fluctuating with the Fed's announcements. Ultimately, my friends, the Federal Reserve's interest rate policy is something you cannot control. You cannot control Jerome Powell, you cannot control the next Fed chair Kevin Warsh, and you cannot control global energy shocks. But you can control how you position your own fortress of clean water. Do not let fear paralyze you, and do not let temporary stability lull you into a false sense of security. Take a look at your accounts today. Look at your cash, look at your bond durations, look at your dividend stocks, and eliminate your toxic debt. Stand strong, be honest with yourself about your numbers, and protect your hard-earned savings. You have worked too hard for too many years to let interest rate uncertainty strip away your dignity in retirement. You can do this, you can be safe, and you can be secure.